evolution is happening all the time. So when you're in markets and if you're observant and you have a little bit of intellect, then you should be adapting your strategies as they go along and reinventing yourself.
Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive, Onyx Capital Group. Today we have a special episode. I'm joined with Chapman for a one-on-one interview. Kurt, recent new friend of mine, was actually a competitor previously in the market for a long time when I was trading, but Kurt goes, way back to the very beginning of the Brent benchmark and how it was formed, how it was traded. He has a plethora of knowledge. It's great to have Kurt in to talk about all these things, but also diving into a bit of the minutiae of Dated Brent and CFD trading and all of that. So thanks very much, Kurt, for coming in. And maybe we could just start with, as you know, I recently wrote a book. Kurt, you helped with it. That was very, very nice for you to have a look through it and
pleasure.
all that. It's the change of the market over time. You've been really heavily involved. So maybe we could just talk a bit about where you started and how you've been going through in your career.
Yeah, sure. I mean, first of all, great to be here. Thank you for the invitation. Congratulations on the book.
Thank you.
I think it's really kind of hit an area that a lot of people have interest in and don't have a lot of knowledge about in terms of the financial instruments that are used in traditionally, physical oil trading market. So I know it's right up your alley, and it kind of, it pinpoints on your business. So I've got 2 copies of the hardback. Thank you for one of them. I did buy the other one. Did buy the other one, and it's a great effort. Well done.
Thank you.
My background, went to university in the States at Harvard, degree in economics. Got out, did 4 years of active duty service in the Marine Corps as an infantry officer, and then went to Wall Street because all my buddies were on Wall Street. Ended up, though, not in a traditional fixed income role or investment bank, but actually in commodities, which was kind of up and coming at the time. It was the growth of the Wall Street refiners, so to speak. And
But
really
you just fell into that, or how did you choose?
My father actually, interestingly, had been working for an oil company, and so I guess maybe a little osmosis or what have you, combined with the desire to, be Bud Fox in the movie, right, or what have you. So really, that's how the doors opened, and got my first exposure really to the financial aspects of oil. Learned about risk management. Morgan Stanley moved me to London, and then from there I developed more of an interest really in the underlying. Went to work at Elf Trading, helping set up their paper trading and risk management system, but then getting some great exposure to physical markets. Back to London with Coke Supply and Trading, and then ended up at Sempra under the tutelage of Marco Dunan and Daniel Yagi, who had been at Goldman and Fibro, and were setting up the international business for Sempra, and that ultimately morphed into what is now Mercuria. And Mercuria has been a tremendous success story, starting in 2004 and growing into one of the largest trading companies now, along with Vitol, Glencore, Trafigura, Gunvor. I'd actually stayed at Sempra for a little while to run the book and grow up and mature, and then the guys invited me to come over and run the crude oil book and business, which I did for about 12 years, retiring in 2018. I mean, you don't really retire; it's kind of semi-retirement, right? You have to stay engaged. So that was my career, and it kind of covers the whole facet of the financial and physical markets.
Well, that's where I was going to start, because being at Morgan Stanley, this is in the early 90s essentially, or mid 90s. So that was when we've had about 10 years of the Brent and WTI benchmark and things growing steadily. But then it was really the change in Brent you were very much around for. So I think was it not even Morgan Stanley themselves that were involved in the formation of DFLs?
I think Morgan Stanley has been involved in several aspects of, what we would call kind of the Brent complex or the derivative market. I mean, essentially, when I moved to London, it was 1991. the Brent contract on IPE at that time had been successfully started only less than 2 years prior to that, after kind of a third attempt. So you did have futures trading, but you had by that time already in the early to mid 80s, you had the 15-day contract that was trading in Brent, and you had this subset of the market called partials, which Morgan Stanley was quite active in terms of marketing. And in fact, my first job was a market maker in Brent partials and actually Dubai partials. And then subsequently, as people started to price crude oil relative to this dated Brent quote that had been developed by both Platts and Argus in the late 80s, there was a basis risk that occurred between the paper markets, partials or either futures that you were hedging in, and the underlying physical that you were pricing off dated. And that's when you got the development of what we now know as a CFD market, Dated Brent CFD market, and DFL market as well. The CFD market was more probably physically cargo oriented, because it was usually a 5-day pricing window, which people would price around or after BL. And the DFL market was more a function of margin hedging, right? Refiners would use it because it was monthly average, and they could price that dated versus the products and unwind it on the screen. So those are how those two markets started to develop.
And they started to interact with each other, right? The refiner's classic trade now is a 5-day CFD for the crude loading, and then the monthly DFL for the margin.
Yes, exactly.
Yeah, right.
That's exactly right.
And just on that, so you came into the market, Brent, not sure how many people know, it was traded in full cargoes. That was how you set the flat price Brent. And every time you bought and sold it, it was in 600 kb cargoes, right?
In the Platts window had always been operating since I had been involved, and usually, while you did get, initially you had 600,000 barrels flat price trading was very common, right? The contract actually after 1990, when you had commingling of Brent and Ninian, became 500,000 barrel contract. But in that period where you had the price discovery during the Platts window, they used to take a weighted average of the partials that would trade, and partials were usually 100,000 barrel.
But that was a new thing when you were.
That had just started, I think, in the late 80s, and so you would. Interestingly, the partial market was the window was after the close. So you didn't have a lot. The price discovery that you got were these 100,000 barrel partial clips that counterparties would trade bilaterally. Right. And then if you did 5 clips of 100, then you ended up aggregating a 15-day contract.
And that was the whole way Brent traded.
That was pretty much the way it was traded. Yeah, that would set the absolute price.
So how would it interact with, because WTI had been going for quite a long time at that point. So as a trader, you're coming in mainly as a financial trader, I guess, at Morgan Stanley.
Correct.
At the time. So you were watching WTI trade, and then that would price your Brent, and you would know where value is?
Initially, yes. Yeah. Before the Gulf War, when the Brent contract was still in its infancy, I can't even say that, can I? When it's in its early stages, the liquidity was still on NYMEX because that was the largest contract. So there were quite a few people who would offer Brent partials, and then in order to hedge themselves, they'd lay it off on the NYMEX contract. Right. So you had these Brent TI positions, but it was less a function of the transatlantic arbitrage, and it was more a function of where can I get liquidity to manage my absolute price risk. And so if the market was going up, the TI Brent would kind of widen, and if the market was going down, it would kind of narrow. And you would make a price, trade the partial, lay off the TI, and then unwind it when it suited you. So
even at the very, very beginning, financial markets were driven by liquidity and flows more than the physical, again, as you're saying.
Yes.
It's always been that way. So I did hear this, I came into the Dated Brent market, and the inefficiencies or the market making was around CFDs and DFLs, but I heard that if you wind it back, a lot of that type of trading, like curve arbitrage, curve stripping, was done on WTI Brent, and I guess for that reason. So there's then some market maker then in between the risk you were offloading. Or
Yeah, and initially the markets traded on an absolute price basis, right? Okay. So people were looking to minimize their, absolute price. They used the instruments for hedging, but for example, if you wanted to do a Brent partial against a physical cargo you were pricing, then that partial would be taken by the market maker, and the market maker needed to lay it off somewhere else.
Right.
And that was essentially the futures exchange. One of the things that did happen in IPE that was not occurring in NYMEX, but now happens all the time, is that there were block trades going on. Mm-hmm. We used to call them two-sided EFPs, where you do a partial, and then that partial was actually put onto the exchange immediately. And that's evolved into this whole block trading idea. So it was off exchange, but now it's become a kind of an acceptable, regulated part of the system.
So this took us up to, it probably lasted all the way to about 2008, where it was all bilaterally traded, mostly the Brent stuff. No, or I guess Brent
it was mostly bilaterally traded. You had to prove your credit worthiness. You had some relationship with certain counterparts. Obviously, there's a provision in the Brent forward market to open an LC if necessary. Mm-hmm. So managing LC costs and who you would trade with and how those things were unwind were important. Whereas now everything is primarily on the exchange.
Well, I find it fascinating because I'm just imagining. I can't imagine being in that seat where suddenly the only way to trade is bilateral. So it makes sense that the banks do all the market making because they have all the bilateral lines with everyone. So you had quite a lot of responsibility, right? If you're taking on essentially the market making role in the Dated Brent market, and there can't have been that many people who knew what to do with the Dated Brent components and all the contracts.
I think as the market has evolved, right, there's been a greater understanding of how it works. We were talking earlier about briefly about what kind of arbitrage would there be between the different instruments and tools, and there's always been an arbitrage, right? Because CFDs are essentially a subset of Brent spreads, because it's all about Brent structure, right? Now you're adding the extra element of dated into it, but there was an arbitrage between a CFD curve and the Brent spread curve. And so when we would look at it, we would say, is it cheaper to buy, if we wanted to own something, was it cheaper to buy CFDs or was it cheaper to buy, Brent spreads? And that was just a function of where dated was relative to the forward market. When DFL came along, then you had CFDs that were a subset of DFL with the added element of the forward market versus the futures market, which could be hedged by Mina Platts or these other things. So there's always been some degree of relationship between the different instruments, depending on how far down the curve you actually went.
But when was it, the idea of when you say Brent structure, the Brent time spread, so it went from trading the outright price of the cargo to that being pretty much managed either by WTI or I guess Brent as it grew. And then where did this concept even of structure come from? Everyone started to price the physical differentials they were negotiating to the next month contract, and that creates the time spread.
Yeah. Well, I think what happened is the market moved, the what I would maybe call the professional market really moved to a relative value approach, which is it's not that easy to glean whether the market's going to go up or down, given all the other different aspects that have some impact on that. But it's easier to identify this relative to that on the curve from a timing perspective, or Brent relative to WTI or Dubai. One is undervalued relative to the other or overvalued, and that's how the trading has really evolved.
Yeah, I guess it's a bit nerdy, but I find that so interesting because it's what people get used to, and suddenly it becomes gospel, and then everything starts pricing off that. So you had this time spread, and as far as I could see, as you say, that was to give you a relative sense of where it's better to buy now, buy later. If it's too expensive, roll it next month, or that kind of thing. But then obviously the storage comes into play, storage economics. So that did that come kind of before or after, or the relationship with
Well,
structure?
I think storage has always been there. It's something that's very difficult to capture in the financial markets, right? It's something really you have to capture in physical market. If you buy physical cargo, you can put it into a vessel or a storage tank, and you can hold on to it if you have the cost to carry it. You have a contango market. Interest rates are not too prohibitive. You've bought the barrels at what you consider to be a decent basis, and then you can use the financial instruments to hedge it, and ultimately you keep rolling it if you're being paid to do so, and when the markets improve, then you unwind the hedges and you sell the things out.
But I like looking back at these things, and I think it's easy for people to say, oh, that's how that works, as if it's obvious. But if you take your mind back to when these things are being formed, it's quite daunting. Even though you know the maths works, you still have to hold the risk and work it all out. Like, there must have been a lot of scenarios for you, either from the storage, from the arbitrage between CFDs and DFLs, where you're confident on the maths, but it's still a bit daunting to put the trade.
Well, I think the biggest issue is where do you put your hedge, right?
Right.
So it's not completely mathematical. It's mathematical in terms of buy the physical cargo, buy the dated swap to price it correctly, hedge it in the forward or futures market, usually in the futures market, because then you would have you'd have greater liquidity further out the curve in futures than you did in forward. And then, okay, where do you put it on the curve? Because in a contango market, usually the contango rolls up relatively cheap every time. So if you put your hedge out too far in the future, then you're giving away opportunity in the front end. Having said that, if the market's turning and you haven't hedged further forward, then you have less time to manage your price exposure, and you have to get out of tankage maybe earlier than you want to. So there is a finesse aspect to it in terms of what's your opinion about the longer term structure of the market.
And then on that point, so looking at where the opportunity is on the curve, did you ever say to yourself, like, I am going to market make this curve and make money that way, I'm going to do physical and do it that way, or was it always combined? Or
I think that was just a part of the toolbox, right? I mean, market making was a tool. Trading relative value time spreads or regional arbitrages were a tool. Identifying physical arbitrages or identifying financial arbitrages, it was just one of those many things that you used to kind of trade around. Identifying flow, whether it was Plats or funds coming in to roll their positions. All those things, you pick and choose depending on where you think there's going to be the opportunity on the day.
Because I think when I entered the market, so I guess you're in your 50s at that point. You're 60 now, if you don't mind me saying.
I am 60. Yeah. I've got my 60 plus bus pass.
Right.
I don't travel until after 9:30.
So I came in and it was, trading against yourself, a guy called Matt Clark, Standard Bank, Standard Chartered, and people really understood what was going on. But I was amazed to learn your age, because you were so all over everything, even after 20 years, 30 years, or whatever it was at that point. And I just thought, it's hard for me to keep up, and I'm meant to be the young 23-year-old or whatever. So that was fascinating for me that you had such hunger as you were, so into it. That's why I guess I asked the question: did you start to look at market making and really get a sense of it and really enjoy it and see that as? But I guess you're saying it was the toolbox, but I can't imagine having to do all that work on the market making and the energy that's needed to stay on top of the market at all times, and then having to manage physical as well. So you must have just lived and breathed and loved it.
Well, I think you have to be committed, right? And you have the similar sort of passion, right? Otherwise, you wouldn't be here. But you build up a system, right? And it's not just you; it's a team. And you have somebody who concentrates more on the physical market, somebody that's concentrating on risk management. We have our risk management systems, but everybody has kind of their spreadsheet, right?
Right. Okay.
To kind of figure out how they're going to price certain things, and the opportunity is for the younger people coming into the business is. you find a mentor, right, and you try to take as much knowledge as they have and work, it's working hard and incorporate it into your own set of skills, and then you go from there. And so, I'm pleased to say that there's still quite a few people in the industry who are doing extremely well, who I worked with, who worked for me, in the past, and it's great to see them, carry on the tradition, so to speak.
No, for sure. Do you think though, when you've hired young people, I guess you've been doing that your whole career, hiring juniors, training them, as you said, there's probably not many crude traders out there who haven't had some kind of interaction either directly with you or from someone else you've trained. Was there the expectation? Because I think some people can confuse what you just said there with so I come into a Mercuria and I want to learn from Kurt, but then the market is always evolving, and of course you obviously evolve with it because of the way you were trading all the way towards the end of your market making career. But some people are quite stubborn, right? This is how I've worked. This is how this works. And if you just exclusively learn that trait, then it's going to be very hard for you to continue to evolve. So or do you think there's an expectation from other senior traders to be like, if you're younger and you're coming in, you need to be learning the modern way of trading as well? That's what you're bringing. Is that too hard to do?
I think it's interactive. Obviously, you try to develop a certain culture, which is, a committed one that's precise, particularly on a risk management standpoint, one that's honest and about, let's face it, we don't all make money every day, right? There's plenty of days where it doesn't go very well, and you need to be honest about how your own performance is. But what I think is that, as you've seen, even my career maybe has spanned a little bit longer than yours, but during your time in the market, it's evolved quite dramatically as well.
Hugely,
right?
Yeah.
Over the course of the last 15 years, and that evolution is happening all the time. So when you're in markets, and if you're observant and you have a little bit of intellect, then you should be adapting your strategies as they go along, and reinventing yourself.
Right, but you're being very humble, because I think that's what every time we've made these changes, even in my 10 or so years, people have been right there fighting for it, and then suddenly the market changes and they're not there anymore, and they really can't learn a new trick, which makes me think they just learned it. So when I came in, I was actually learning off you, and maybe Matt as well, because how else am I?
Maybe I taught you too well.
So I'm watching you, how is he doing this? Why is he doing that? And you figure it out as you go. But there was no other way, because no one in my firm, we were a very young firm, no one knew anything about Dated. So
it's being observant, right?
It's being
you
observant,
need to be observant,
but the confidence,
and internalizing that and saying, okay, well, why are those people doing those things?
Right. But there's a humility to that, because if you think that you're the veteran and you're the finished article, you know how things work, you're not going to try and adapt to the market. You kind of think this. I've seen this before, I guess is what I'm saying. There's some people who just think, well, no, you should adapt to me, and this is the way it should be. And those are the people that don't do as well, is from what I've seen. Of course, like this. And
it depends on your perspective. I mean, a lot of people will be like, I have a certain set of knowledge and I don't want to share it, and I want to keep it like that. I guess my feeling was always, I was going to try to understand as much as possible, and then try to be smarter and faster.
Right.
Which doesn't always work out. But I'd rather have a dialogue and interact with different people and get ideas from the team and outside the team, and then really try to figure it out.
Could I ask you about, so 2012, 2013 is when I started, and it was just when the swaps were going to the exchange, so pretty much overnight change from the bilateral trading we were used to. Again, I just assumed that was, because I'd never seen any different. But how immediate was the change? And I guess once Dated Brent was now on the screen, I guess what were the big early changes that you saw?
You had more players, right? You had this whole category of players like yourself, financial trading companies that entered into the market and could identify opportunities and make it more efficient, right? Was it? Did I prefer the bilateral days initially? Yeah, certainly I did, because It allowed you to interact with a counterparty who maybe knew really what was going on in the marketplace. The bid offer was a bit wider. There was an opportunity to capture more of the value in the market. But it's a trade-off between liquidity. And in some ways, you develop this whole on the exchanges, you always had locals, right, that would provide absolute price or spread bids and offers of certain size. Now that was just expanded when we went electronic, and everything went onto the screen into all the other instruments that make up the Brent complex.
But I guess, the one thing about North Sea trading and Dated Brent is that even now it's still not known by a huge number of people. It's still niche. It's still very complicated at the end of the day. But I think what I would speculate is that the big change in the early days was actually probably not a huge change in terms of the physical impact on the market. But as you went through the years, at least it seemed to me that the edge on knowing the physical barrels, where they were moving, when a VLCC was booked, or anything like that edge started to diminish. And I don't know if that was also because of physical efficiency as well as paper efficiency, but certainly I was told you don't go into the Dated Brent market, you don't go into the CFD market because it's a wild west, and you could be buying one day and then it all goes quiet, and then come the window everyone's selling because there's been a fixture that's been cancelled or something like that. And how could you possibly know that unless you're trading the physical? But for some reason that stopped having a huge impact, and I guess that was the liquidity.
It depends where you position yourself on the curve, right? You're quite familiar with the fact that there's an arbitrage between DFL and CFDs, right? And the CFDs are usually trading in weekly periods, and the DFL monthly, and there's the implied EFP, right? The forward versus futures aspect of the two different instruments, but if there's enough liquidity, right, the more liquidity there is, and the more opportunities there are, the closer the further forward you can be in the market. But if you're going to trade the dated market this week, like you say, there's two handfuls of people that can drive the price transparency in that market. So I still think that's quite impactful and important up front, but down the curve, perhaps less so.
But even up front, I remember it was, the only way I would touch CFDs is if I could arbitrage it out, and you accept an element of residual risk. But as we look at it now, I think my guess would be what's changed is actually there was only one or two trade houses and one or two majors who would be heavily involved in the EFPs, right? They would have the appetite to have substantial volumes traded on that, and that has democratized. So there seems to be like 10 or 15 companies that are willing to, as I say, the physical liquidity seems to have evolved. Therefore, you tend to get, especially on expiry, but even in the front of the curve, you tend to have quite a lot of visibility on how people are thinking, and there's occasional shocks, but it's certainly not what it used to be, essentially. And maybe that's a function of the changes that Platts brought in, like the end of the the introduction of de-escalator, the quality premiums, of course, Troll and the WTI Midland. Is that fair? Like they were starting to look at what was dislocating?
Essentially what's happened, and it's no surprise that as North Sea production has declined, the underlying pool from which you could determine the price of dated has been under threat, right? And so, the first thing that happened was in 1990, actually, you had Brent and Ninian commingled. And that was the kind of famous Suco 90 GT&Cs, which is the basis that we're all kind of still trading under, to some degree. Then in 2002, you had the introduction of 40s and Oseberg. 2007, you had Buzzard that went in to 40s, and then you added this de-escalator to try to make the 40s barrel a little bit more sweet and in line with the other North Sea grades. And you had the addition of Ekofisk, and then ultimately Troll in 2018. And then now, finally, we've seen the introduction of Midland this year. I think what happens is when the pool gets wider, there's more participants, right? Because number one, not only you're kind of bolstering the volumes, but you're bringing in other players. And what we've seen with Midland now is you're seeing, people like Phillips 66, Coke, back into the market. Exxon a little bit more active. Oxy, the large Midland producer in the dated market. So as the underlying pool expands, you'll get more players. But it's still relatively concentrated when you look at the window every night in terms of who's buying and selling Midland or 40s or whatever, which is going to have an impact on the data quote.
Yeah, it's just, I love talking it out because, as you said, even I've seen loads of changes like the Midland, like Troll, like the EFP changing in 2016. And I may be talking a bit about that. That was kind of my, probably in the third year to me being introduced to it. And suddenly everyone was interested in the February contract, where the February dated versus the, I guess the March, April, or probably just the Feb March futures. That was starting to change. We went from...
Yeah, it was Feb March.
Yeah, okay. It was essentially that Brent versus the relationship between the monthly dated Brent and how that was being priced, essentially crude being 10 to 30 day loading, was going to be aligned with the futures that were at the time only using 1 to 15, right?
They were using the 15. They were using which was really 7 to 15, right?
Right.
So it was the futures contract was on the basis of the original 15-day forward market, whereas the market by then had moved to month ahead. Actually, it moved to month ahead in 2015, and it wasn't until 16 where ICE recognized that they needed to change the contract to be in line with the forward market and go month ahead.
Well, this thing, we can talk about it because it's gone now, but at the time it was, you hold a CFD, you work out all the weekly contracts to get what an implied DFL, you trade the DFL against that, and what you're left is this relationship between the Brent forwards and the Brent futures. Now, when it was 15-day Brent, it was basically like a third of a hedge was like a third of the volume as Brent spreads. And again, you had to just look at all the mechanisms, look at how things were priced to come up with hedges like that. And that, for the longest time, was how things functioned and how things held together. Then you come up with this new change that suddenly Brent futures is 30-day loading aligned with the dated and therefore the EFP. The EFP is suddenly, well, how do we price the EFP now? Is it zero? And for the first few weeks, I was like, well, it's got to be zero. So I had it marked as zero, and it was pricing like 10, 11. I was like, what's going on? But then obviously you have to factor in, there's value in holding these forward barrels. You got to price that in. There's operational tolerance, and this is my lagged learning, right? Because I can only see the market as a financial player play out, see what's happening in pricing, and then try and reverse engineer what's going on, and then start to come up with the new hedges. But for me, that completely destroyed it was a good thing. It really aligned the efficiency of CFDs versus DFLs. So suddenly you can change them a lot more interchangeably.
It would have made it easier for you, in my mind, because you would have less dislocation. Beforehand, you had this dislocation of 15-day versus 30-day and the contract. So essentially what would happen is the dated market was trading at a steeper discount to the paper market than you would have expected, right? Because you could hold futures for longer without being penalized with owning a physical cargo.
Yes.
Right? And the EFPs would also respond to that as well because they were going negative. What happened is when it came back into line, that relationship between dated and forward was more recognizable, less prone to dislocation, and the EFP, increased in value to the kind of 10-cent level that we're seeing pretty consistently since that period. So as someone who's arbitraging, DFL, which is futures related, versus CFDs, which is forward related, it's easier to get a grip on. You could take that basis risk, right, and you could manage it as opposed to,
this is what it always seems to be, because that's great.
Putting it,
exactly.
Yeah.
So therefore, people could have a lot more confidence, and then people are a lot more trading CFDs. But the problem with that is, as you said, the futures were closer to the dated prices in the prompt, so they were closer to physical. So you could have quite a nice relationship with, it wouldn't work all the time, of course, but hell of a lot of dated buying, VLCCs booked. You could buy the front spread and it would actually move related to the physical information. And then what I remember happening 2016, and when I came and started Onyx 6 months later, so this the latter half of 2016, I remember one trader in particular, a major, had kind of realized, well, actually, now that it's further out, it's a completely different loading cycle, so it can have completely different economics. There's nothing actually really tying, apart from the extreme cost of keep, holding these contracts together. So I know this is convoluted, but like ultimately, I remember that it was essentially selling the crap out of Dated, or ultimately bearish Dated loading programs over flooded, but then bullish on the time spread. So the time spread would be rallying and the data would be going lower, and there would just be absolutely no relationship. So suddenly you've got a front spread just driven by like forward financial liquidity and nothing to do with the prompt physical market. And you had to then speculate on the physical market like 2 months forward to have an interpretation of the Brent spreads. And that was a big change. Suddenly you're into like supply and demand forecasting rather than actually looking at the physical. And that's a breakdown.
No, you're right, because you went to an extra month, right? So the CFDs started trading at an extra level of maturity, but it also meant that, you know, people like yourselves could have more influence on setting the dated every night, because instead of a 2-week structural period, it was 3 weeks.
But is that a good thing? That's the thing. So people say, is financial liquidity a good thing? So I would say it's a good, like if you use this exact example, well, allowed people to trade CFDs more because it was more aligned and more efficient. But it just empowered the financial liquidity so much more. And is that a good thing?
Well, that's a question that I've asked myself, right? I mean, it's a good thing from the standpoint that you get better price transparency and you have more liquidity, and that's what the price reporting agencies want to see, which is why when swaps were listed, it allowed people like yourselves to be listed on the e-window to trade CFDs. I mean, you don't trade partials because you're not in the forward market, and you don't trade physical, which are the other two aspects of setting that make up the dated quote. But it allowed this whole slew of new players in to have some influence on a third of the price setting mechanism. I think as a physical guy who is also in the paper markets, it meant that you had to change your strategy. You know, before there was it was kind of arbitrage for me, and it was less transparent, and we would make certain instruments available to people that wasn't seen in the market. Now it's a function of, okay, there's a financial player who's arbitraging something further down the curve or versus DFL, and if you didn't feel like that was the appropriate value, then you would take the other side. And that's what we've evolved into in oil trading anyway. When you look at the huge macro funds in the market and the who are setting the absolute price, certainly the industry is not, where's the opportunity to go against the financial flow because you have a conviction about where the physical market's going to be? Now, it's brave to catch the falling knife, as we say, but that's the mentality that has had to creep in, I think, in the industry. Do you go with the flow, even though you don't believe in it, in order to kind of go against it? All those scenarios have come to the forefront now.
But the one thing you can't financially influence is the physical differential, and that's still a decent enough component. So I've seen more of a switch to traders with a very high conviction on where the physical differential end up being, trading a 3-week roll, essentially, much more. Yeah. Right. I think my take on it is, I do think more financial liquidity, it clearly evidenced from everything we've seen, helps make a market more robust and build out. But it's still, investors still want, especially macro investors, and especially if you want even the end user, like the everyday people, to be able to hedge one day, they need something that aligns to the physical. And the problem is that in this current way, you're just, if you push forwards like what futures has done, it's 2 months forward now, then if you want to capture that correction from financial into physical, you need to trade a contract that relates to that, which is not the Brent futures or WTI futures. You're going to have to trade dated. So what I think we're encouraging people to do over time, and what hopefully we'll do with retail access, is say you should be trading dated Brent. Because if you want to capture that physical, I'm passionate about the physical being where it is, and I think the financial market's in a la-la land, okay, well, the only way to capture that is if you take the dated Brent risk into the end of expiry, and that's all you can really do, and not enough people are doing that or aware that's what you have to do.
I mean, I guess that's the DFL market, right, which is why you've seen probably an increase in traditional industry players into DFL, right? Because that's the link between the futures and the dated. Okay, it's a monthly average. It's not pricing in the specific week. I mean, it really depends on what, how big the basis is these days. Granted, in a very strong market, the data will perform maybe better than futures in a week, vice versa. But again, with everything somewhat aligned to this 30-day, the month ahead contract, and futures being the same, how many people really want to have that, really concerned about that basis, if that basis is only 20 cents, for example?
Sure.
So,
but it's just the logic that the physical market is dislocated. The only possible way you're going to capture that dislocation is by holding these contracts more related to the physical.
I think one of the things that's interesting about Midland coming in is that price discovery is now moved to the U.S. Gulf Coast. And that's something that we may see in terms of the evolution of evolution of instruments in order to say, okay, well, Cushing, is more connected with the international community or the international price of oil than it ever has been because of U.S. exports. But Cushing is still pretty regional, and we've seen, Cushing dislocation of 2020. I mean, going negative, right? Which was a pretty amazing situation to watch. If you get this development of instruments, tools that you can use in the Gulf Coast, East Houston, for example, Midland, then that really, being the marginal barrel, that's really where the price of crude will be set. And then there's a relationship to Brent. But I saw a chart recently, it was quite interesting, from the Argus conference that they had last month, and that the price of TI Brent is very much correlated with freight between U.S. Gulf Coast and Europe,
right? And
that's not a surprise, right? Because Midland is in Dated Brent now, and probably sets a quote about 55-60% of the time.
So you think there might be new contracts forming to capture that economics?
There is some. There are some swaps that exist. East Houston versus Cushing. I mean, still the basis will still be Cushing, right? Because that's where the liquidity is, as you know.
Right.
But there will be some swaps or some contracts that relate to that that should provide pricing really on the Gulf Coast as opposed to just Cushing itself.
And I think, thinking geopolitically, that is something I guess I definitely hadn't fully appreciated when you say it like that. So directly influenced the US that actually OPEC probably don't love that, right? At the end of the day, they would prefer their crude, like Murban, for example, the contract there. People use more related contracts to Middle Eastern crude. So do you think? I think I asked this at a kind of conference you were speaking at, or an event you were speaking at. Which is surely, like if I was one of the Saudis or one of the OPEC countries, I'd be pushing to have my crude pricing one of the key benchmarks as well. You don't think that's likely to happen?
Well, I mean, it does price for, they do set the price versus Dubai primarily.
But in the highly liquid futures,
in an ideal world, being kind of the free market trading guys that we are, we would say Arab Light should be the sour contract that should be freely traded at point of origin, right? Now, I don't see the Saudis ceding control of the price of their crude oil to the marketplace, and I wouldn't even advocate it for them, right?
Yeah, got it.
Because that's their natural resource and very important for the stability of their country. So, but you do see how they adjust prices relative to some of the relative to the regional benchmarks when they put out their official selling price.
I think for me, like what your career encapsulates so well, and your thinking is that when you create a marketplace and the necessity for a financial benchmark as well as the benchmark itself, is that you have to get the liquidity right first and reference that as a relative value. That's kind of essentially what a lot of what we've been saying. And I still think people have a problem with that. They're saying, if I've got a contract that's related to a very important crude or product, that should be the contract. And it's just not how it works. And I guess, well, like even WTI, it should have been LLS really, ideally, the Gulf Coast crude. I think they tried that at the time and it failed. Why do you think some contract, like what is it about Brent working and not, say, another contract? At the end of the day, it's arbitrary, but the liquidity goes there, and that's the most important thing.
I think, there was I think Brent came about for a couple reasons. One was there was a need to have some sort of price discovery in Northwest Europe. I mean, there's always been a trading mentality in Europe because Europe has been short crude. So they were buying crude from other regions. They were bringing it here. So there was a commercial interest there. And then you had the discovery of North Sea oil. And that North Sea oil was not, it wasn't too concentrated in terms of the number of participants that were involved. So it couldn't be easily, controlled by one company, and it was freely traded, where anybody who had the financial wherewithal in the system could come in and start being involved in it.
So it's the appetite of the trading mentality. That's a nice
so
way of
there was an economic need for hedging instruments and price discovery, and there were the other elements that came together, and one of the reasons that the contract was successful, which was the third attempt, is that it was broken into subsets, right? And the interesting thing is that if you look at TI physically settles. You hold WTI, you'll ultimately get physical oil in Cushing. If you hold Brent, you won't get physical barrels unless you convert them into the forward market. And then if you hold the forward market, then you will get the physical barrels. So there's that extra step of complexity, and it's just become more and more complex all the time.
I'd love what you're saying though about it's the trading mentality that causes a contract to be useful ultimately. It sounds so obvious when you say it, but I think people don't think like that. And it's a nice way of putting it. But on that note, this appetite for trading in Europe, Grangemouth refinery just being announced is going to go down. That's a key, or what used to be one of the key outlets for North Sea oil, West African oil. And, it may only be one smaller refinery, but is this part of the trend, as we've kind of been promised, of the end of European refining, slow decline of it? And if so, what happens to the benchmark if constantly, basically what's happening is it becomes like a port, it almost becomes like Singapore. You come and bring your crude here, price it, and then you send it to other places in the world. So even more trading activity, I guess you could see more trading in this contract, or less.
I mean, the Grangemouth announcement didn't actually really surprise me when you look at the fact that there's only 7 40s cargoes a month now, and Grangemouth can take 4, and that production is going to be more declining. Essentially, the cost of feedstock, cost of crude oil is going up for them. They were usually, the refinery was getting we don't have to transport it from location A to B because we're at the end of the pipeline. So that doesn't surprise me. Along with energy transition, I guess there's going to be less demand for transportation fuels in Europe, probably more so in Europe than in other locations. And what it may spur is more products trade, from outside the region, whether it's India or the Middle East or the U.S. Coming into Europe to meet those needs. And that's already started to happen with, the ban on Russian products. And you're seeing some companies that are rejuvenating their product trading businesses, particularly the U.S. companies here in Europe, in anticipation that this will be an outlet. Refineries will be rationalized for the right reason, and they'll be doing, you'll have to get into product arbitrage.
Sure, but I still think that West African crude, US exports, WTI Midland, there's still North Sea, there's still a lot of North Sea, right? And Mediterranean, they're all priced to Dated Brent, but suddenly you have less local refineries over time able to actually take the crude. So the economics of how those crudes are being priced is much more about where they'll eventually end up, which is probably going to be the Middle East and Asia refineries. Yeah. And so it's a bit of a weird situation for actually pricing. Everything becomes an export grade, basically. And how that actually prices Dated Brent will become...
Well, no, it's an interesting point. I guess if you're kind of looking, at 10 or 20 years down the line, you're saying what is going to be the relevance of Brent? Well, the relevance of Brent has always been it's been the marginal barrel in the Atlantic Basin, and it's moved to other locations. But we may find something like Dubai or Murban or these things take more prominence, right, as the demand for oil will be in Asia. It won't be in Europe. But that's been the situation for the last 20 years as well, or the last 15 years as well.
As you say, it's the willingness to trade it freely and to freely price the benchmark. Unless you have that, it's quite hard to get active trading on that benchmark. And Dubai doesn't have the CFDs, the weekly contracts, but it could, right? We could go there.
No, sure, and that gets back to the point of price discovery in the U.S. Gulf Coast, right, where that marginal barrel is originating. And if it's not going to go to Europe and it's go to Asia, well, I'd like to know what the price is when I pick it up, in Corpus, rather than what the price is potentially at ARA. And don't forget, you have Brazilian oil that's coming online. You have Ghana is producing a lot of oil now. So maybe it means that Midland price takes on a benchmark aspect of itself as outside of the Dated Brent complex.
I see what you mean.
And you may get some of the instruments that you have in Dated Brent, whether it's maybe not weekly CFDs, but decade pricing,
right,
inside WTI.
Right.
So you'll see more prompt structural instruments that say, okay, if I get the first decade, it's worth this versus the third decade inside a particular month.
That'd be very
have to
interesting.
see.
Yeah. Maybe just finishing on the Brent market now. Bit of a wait and see attitude. Everyone's kind of, especially in Dated, just doesn't really want to touch it. It seems a lot of uncertainty. Is that how you're seeing it too, or do you think there's people generally just expecting one thing or the other? Or
I think the contract, the introduction of Midland has actually been relatively successful. When you look at the amount of trading that is occurring in the EFPs and on spreads, particularly on expiry day, it seems to be relatively robust. Volumes in CFDs, parcels in the window is pretty robust. There hasn't been a massive change in the forward curve in terms of the Brent complex.
So we've aligned. I actually meant more about the OPEC decision coming up.
Oh, right, about the OPEC decision. Right, okay. We'll leave. Anyway, the point about Midland being introduced, I think it's worked out pretty well.
Yeah,
the OPEC
agreed.
decision, we're all watching and waiting, right? There seems to be no war premium in the market anymore. There's certainly been more non-OPEC production available, which has put pressure on markets. There's been a lot more comfort for the CTAs to be short the market because we were flirting with contango, certainly in WTI and a little bit in Brent. So that rolling mechanism is suitable for short positions. I think the Saudis are pretty determined, and I would be very surprised if they would not put a lot of effort into hold the line. The concern, of course, is in 2014 they decided a different strategy, and in 2020 briefly when they had a disagreement with the Russians and said, okay, if you want oil to flow, then we'll have oil flow, and we're the ones with all the spare capacity. And the market, the market will be under some serious pressure. But I suspect that there's going to be certainly a rollover, maybe hopefully better compliance. Will we get a shock of some kind of cut? It's not impossible, but it does make it very difficult to trade right now until we get some clarity on what's happening tomorrow or through the weekend.
But you think it's likely they will be determined, so you kind of see the risk towards the upside, or?
I would say that, with the market being as short as it is, and still some determination and still some uncertainty surrounding the geopolitical situation, I would say that there is a slightly more risk to the upside.
Interesting. All right. Well, Kurt, that was just really very fascinating for me. I could talk for hours with you about how everything's gone over the years. But thanks very much for your time. And Thanks for coming in.
Yeah, appreciate it. Good.
And thanks for listeners out there. I really hope you enjoyed it as I did. And please tune in again for more market updates and more of the same next week. And please like, follow, comment. It really helps the channel. And thanks for listening.